Afternoon. First and foremost, I don't have a camera. This will be remedied by next week's webinar, but this week has just been a bit of a nightmare. So bear with me. You can't see me, but really you're not missing too much. Today is the first in a series of 12 weekly webinars that we're running on behalf of the East Midlands Growth Hub Cluster, and it's part of the Empowering SMEs and International Trade programme, and I'll cover more about that funded programme towards the end. If you're joining us from outside of East Midlands, welcome. Please feel free to sign up to all the other webinars in this series that you think might be of value to you. I know we may have some fellow experts that were scheduled to join the call today, so please feel free to volunteer anything you believe will be useful in the chat. My view is every day is a school day and it's fantastic to learn from each other. I'm hoping to have some time for questions at the end, please do put them in the Q&A. If I don't manage to answer them all, because I'm notoriously bad at keeping to time, contact details at the end of the presentation. We can circulate the presentation after today. So just feel free to drop us a line and we'll get back to you. Okay, so we've got quite a packed agenda. There's an awful lot to get through. Just let me move my slides on here. So we're going to talk a little bit about, we're basically talking all about customs compliance today. So it's important to understand the laws and the regulation that govern that compliance. We'll talk a bit about customs processes because they're different for both imports and exports and also for standard and non-standard goods. We'll talk through customs declarations and importer and exporter of record responsibilities. Tariff classification, you'll hear me talk about a lot because that's absolutely crucial. With compliance, we'll discuss exactly how that is. Rules of origin, again, important. Customs special procedures and facilitations, which are probably being more used by our importers now than ever since our exit from the EU. We'll talk about market regulatory compliance. So when you're breaking into new markets overseas, or similarly when you're placing overseas products onto the UK market. Denied party screening is something that's often overlooked by importers and exporters, so we'll touch on that. We'll touch on prohibited and restricted goods. Proof of export is often an area where our exporters are not compliant and is often one of the first elements that's picked up during an HMRC audit. So we'll talk a little bit about that. And then we'll talk about importers' responsibilities when it comes to customs valuation and payment of import duties and tax. And then importantly, maintaining the correct documentation for the requisite period of time. And then the awful bit at the end, kind of like the impact of not getting this right from the very beginning, the kind of penalties that can ensue. Then I'll cover the Empowering SMEs and International Trade programme. For those of you that are joining us from the East Midlands, there's a lot of fully funded support that you can access via that programme. But then even for those of you joining us from outside of that area, we have obviously this series of webinars, which we'd love you to join up to. And also we've got various different offers of free support afterwards, if that's something that you want to look at. Okay, so just talking about UK customs law. As I said, we're talking all about compliance today. So HMRC is the UK's tax payments and customs authority, okay? And the primary legislation that's utilised for trade, governance or trade compliance I've listed here, but then there's some 120 plus statutory instruments in addition to that. So UK exporters will mainly interact with HMRC, but there are other ministerial departments and bodies involved in the movement of goods into and from the UK also. So we've got the Department for Business and Trade, DBT, which was formerly known as DIT, Department for International Trade. That gets involved because it supports businesses wanting to sell overseas. So they provide things like training programs, funding, country export guides, trade missions fairs, and so on. But they also play a really important role in controlling the flow of goods. So they oversee the UK's export and import licensing and control. So you might be familiar with SPIRE and also with ICMS for import licenses. So DBT has a very important role to play in the import and export of goods. Then you've got the Department for Environment and Food and Rural Affairs, so DEFRA as we know it. So that's essentially the UK's central competent authority for international trade. So certain countries, including the EU, require that some UK food and drink exports are certified by a UK certifying authority before they can be exported. Local authorities and district councils can provide that certification as well, but by and large, it falls under the remit of AFA, which is governed by DEFRA. So products of animal origin and so on require certification that falls under the remit of DEFRA. You've also got DVLA, because you may have to obtain a certificate of keeper for an abnormal load trailer if you want to use it outside of the UK, or if you have to replace a lost certificate. So that's another ministerial department that gets involved. Then there's others like Department for Science, Innovation and Technology, and importantly, Arts Council England. So a lot of companies aren't aware that you actually need a UK licence to export cultural objects from the UK to any destination outside of the UK. So I'll cover how you find that information in a little while to make sure that you're aware of what your compliance requirements are. Okay, so just moving on, because there's so much to cover. As I said in the introduction, there are different processes, data and documentation required for exports and imports. And then there's also different processes involved depending on whether the goods being shipped are standard or non-standard. So standard goods are a lot less complex and can typically be shipped with a declaration, a commercial invoice and a packing list. But non-standard goods have more complex requirements placed on them. So I just mentioned before products of animal origin. So from an exporter's perspective, if they're shipping products of animal origin, they're going to need to obtain an export health certificate, or sometimes we refer to them as sanitary certificates, before they can physically ship those goods. If they're on the flip side, so they're actually importing those products of animal origin, then they have additional requirements such as pre-notifying the Animal and Plant Health Agency, so AFA that I referred to earlier, that a shipment is due, and that goods will have to be routed through a border control post so that required checks can be done. So the responsibilities for these processes are largely dictated by the Incoterms agreed between the seller, so the exporter, and the buyer or the importer. So if, for example, an importer is shipping Ex Works, which we never advise, it will be for the importer to collect the goods, meaning that they'll have to make the export entry in the source market and the import entry into the UK, as well as managing any pre-notifications and certifications, etc. So it's really essential that you understand the implications of the Incoterms that you're agreeing to, and therefore the processes and compliance requirements that you're going to have to meet. I hope that makes sense to everybody. Now, moving on to customs declarations, the C88, which looks a little bit daunting here in its paper format, this is the document upon which all UK export and import declarations are based. So the paper copy looks more complicated than it actually is. Typically, your freight forwarder or agent will have software that interfaces historically with Chief, but now HMRC has moved to CDS. And those kind of software platforms intelligently guide the agents through the process of completing the declaration. But essentially, a declaration is looking to communicate to customs who is moving the goods. So is it a trader? Is it an agent? Is it a customer? What is being moved? And we denote what the product is by the commodity code, or you might refer to it as the HS code or tariff code. Why are the goods being moved? So are they for temporary or permanent import or export? And that's denoted by the CPC code that we'll come on to shortly. How much goods is being moved? So the value, quantity, weight, packaging, how the goods are being moved, so what kind of transport they're being shipped by, and whether those goods require any kind of licensing or certification. And then importantly, where from and to, because there are some countries that may be the subject of sanctions that we just physically can't ship to. Okay, so the customs declaration, the C88 works for both import and export. It's just different fields are completed depending on whether it's an import or an export entry. Now, the burden of responsibility for the accuracy of declarations typically lies with the importer or the exporter of record. Most agents that you use will only operate in what's called a direct representation capacity, meaning that so long as they follow the importer or exporter's explicit instructions, they bear little to no responsibility for any misdeclarations or underpayment of duty and VAT. It's really rare, actually, that agents will operate in what's called an indirect capacity, where they share a level of responsibility and liability. And to be honest, that's typically where you might have a logistics company that is a sister company of a manufacturer, so they're linked in some way. It's important to note that both import and export declarations can be amended with HMRC, but I can't stress enough, prevention is preferable, as repeated mistakes and amendments are going to raise your profile with HMRC and might lead to either an early audit or a more frequent series of audits. So for export declaration amendments, you use online C81 form, and again, I can forward this information to you. And for import declarations, with the emergence of CDS now as being the platform, it is possible to amend an import declaration right the way up until the point of the final tax calculation message is received. But once that declaration's been cleared, it can't be amended using the platform. So then you're in the realms of having to file amendments via the online forms. So for a voluntary clearance amendment, so say there's been an underpayment of duty and VAT, then you're looking at form C2001. Where there's a repayment of import duty and VAT, like say there's been an overpayment, then it's form C285. Okay, so there's going to be certain information that you need to submit these forms. So you're going to need things like details of the declaration that you want to amend, the entry date, the movement reference number, so on, and all of your company details. But again, I can't stress enough that vigilance and internal audits are key, because HMRC is more likely to look favourably upon discrepancies when they're dealt with proactively than when they're picked up during an audit. Now, this C88, or the single administrative document as we refer to it, you should keep this document for at least 4 years for customs export purposes. That's the minimum period. If HMRC was to think that your company was subject to a criminal investigation, then the 10-year rule applies. So you keep the C88 or a copy of the C88 and all commercial invoices and valuation forms and everything that kind of that are linked to that, if that makes sense. Okay, now tariff classification I mentioned earlier, really important. It's paramount in trade compliance. You'll be familiar with your commodity codes if you're trading already. So sometimes referred to HS codes and tariff codes, as I said. Import tariff codes are typically 10 digits long, 8 digits for export. And these codes are standardized under the World Customs Organization harmonized system, hence the HS part of HS code. But it's the first 6 digits of the code, meaning that those first 6 digits of a product should be the same regardless of country, so long as that country subscribes to the harmonized system. Now, the harmonized system allows additional digits to be set by customs authorities. So historically, numbers 7 and 8 in our HS codes were historically set by the EU as part of its common external tariff. And then the UK government applied figures 9 and 10 for typically for statistical purposes. You can get tariff codes that are longer in the case of some food products, like to identify sugar, starch, fat content, or for trade defence measures for cap goods, for example. It's really important that you familiarise yourself with the commodity codes and check them against the UK trade tariff regularly. Your goods are subject to scrutiny both for export and import via border control, and correct classification is your legal responsibility. That's really important to remember. As the importer and exporter of record, it's your legal responsibility. And I've said here just why they are important. So essentially everything hangs off the commodity code. They're required for all customs declarations, and I've given a list of why they're important here. Wrong codes can result in the incorrect payment of duty, which is, worst case scenario, but also incorrect filing of paperwork. Maybe you haven't obtained the correct supporting documentation. Then that links to delays or confiscation of goods, penalties, which can actually be civil and custodial. And it's important to remember, as an importer, you have a duty to ensure that the goods are declared correctly. That means that you can alter the commodity code on the import declaration, making it different to that on your supplier's commercial invoice, if that ensures you're compliant with UK customs. So as an importer, you're not bound to use the same commodity code that's on your supplier's commercial invoice. Remember that the tariff's an organic tool, so new commodity codes appear all the time. So you can subscribe to HMRC updates. You can consult HMRC if in doubt using the tariff classification service. Now that's not a legally binding advice from HMRC, but it does demonstrate a level of due diligence around product classification. So it can, if in doubt, be a good option. If you're placing goods on the EU and NI market, not NI, I keep referring to it as NI, but Northern Ireland market, you can apply for a binding tariff information or a BTI. And if you're applying for a tariff ruling for products imported into or exported from Great Britain, then you can apply an advanced tariff ruling. For those of you that aren't aware, the Northern Ireland Protocol effectively suspended Northern Ireland in some kind of hybrid, kind of like a hybrid country, somewhere between the EU and the UK. It's still in the UK customs territory, but it's still in the EU single market for the purpose of goods. So that's why we distinguish between Great Britain being England, Scotland and Wales, and also Northern Ireland as being different. Okay, hopefully that's clear. Moving on, another area of compliance that both importers and exporters have to be aware of is origin, and especially where it concerns preferential trade. So the origin of the goods is where they've been grown or produced or manufactured, and that might not necessarily be the country where they're shipped or bought from. Okay, so origin is different from where a product is being shipped from. We've got the notion of wholly obtained and sufficiently processed. So wholly obtained would be, for example, grain that has grown in that country, or animals that have been born and raised in that country. They would be wholly obtained. But sufficiently processed are those goods that might have been produced in a country, but there may be component or constituent parts that were sourced from other countries, but there's been sufficient processing done to those goods to confer origin. We've also got, you might have heard reference to cumulation. So we've got bilateral cumulation, diagonal cumulation, regional and full cumulation. Bilateral cumulation is what we see in the UK and EU trade agreement, whereby we can effectively count EU origin goods as UK origin goods for the purpose of that trade agreement alone. So it's very different to origin when we were part of the EU, and it's important to understand those differences. Rules of origin apply to all goods, whether they're covered by UK trade agreements that we've forged. It's going to take us some time to replicate what we had as part of the EU in terms of preferential trade landscape, but we're getting there slowly. So UK trade agreements that have been forged, origin is important for. You might also be aware of the generalised system of preference as well, which origin is important for. And then often there's non-preferential rules of origin as well, where countries simply want to or have some regulatory requirement to understand the origin of goods before they can import them, even though there's no duty or financial benefit. Now, I mentioned before about the generalised scheme of preferences. So this really falls into unilateral agreement. So the UK generalised system of preferences that is a scheme that's designed to promote economic growth in the developing world. We effectively reduce the duty or zero rate the duty on goods that we import from a certain number of countries. We've got 3 different brackets, all on the government UK's website. We were part of the EU GSP system, and now we have our own. So the least developed countries framework is the largest group, and the enhanced framework is the smallest group. Be very careful. Some countries, the one that springs to mind is India. India is actually part of the GSP, but only for certain products. So again, it's really important that you consult the UK tariff and understand whether the product that you're importing has a GSP import duty rate. If it's coming from India, it could be that it doesn't. When you're importing under preference from the GSP nation, you must have the goods must be accompanied by a valid proof of origin, and that is historically a GSP Form A, but also you can accept an origin declaration. So that can come from the exporter themselves. So it must clearly identify the originating goods, but they can basically self-declare the origin of those goods. Then we've got bilateral trade agreements. So they're reciprocal agreements. So a good example is, like I say, the UK-EU Trade and Cooperation Agreement. Very different to free movement of goods that we had prior to 2021. This is very definitely a preferential agreement governed by product-specific rules of origin. Okay, so the complications that we see now is that, for example, because it's a preferential trade agreement, UK origin goods can enter the EU tariff-free, but if they have to be shipped back to the UK, they could attract a third country tariff upon re-entry to the UK, unless they go into a specific customs procedure, or if the goods have been returned following repair, because there's a specific clause in the agreement that says that duty shouldn't be applied on goods that are going between the 2 parties for the purpose of repair. Each trade agreement includes a list of product-specific rules of origin, and it will also include details of acceptable proof of origin. And importantly, it includes a list of activities that, when performed, will not be sufficient to alter the origin of a product. So, for example, you can't import goods and simply unpack them and repack them and say that they're of UK origin. So unpacking and repacking is a classic example of insufficient processing. And also in the UK Trade and Cooperation Agreement, they give an example of the grating of cheese doesn't change the origin. So if you import EU cheese into the UK and you grate it in the UK, you're not doing sufficient to confer UK origin. Now, it's the exporter's responsibility to correctly declare the origin of its products and provide the right proof of origin. And that proof of origin is what's referenced in the specific trade agreement. But in terms of your compliance with HMRC, you should be maintaining bills of material for all of the products and that you carry, and those bills of material should really be renewed annually to account for any supplier pricing or component changes that could affect the origin of the products. Under the UK and EU trade agreement, there's actually 2 accepted origin proofs. There is the statement on origin that the exporter makes, and then there's importer's knowledge, and here the burden switches to the importer to satisfy itself that it has enough information and data to validate the exporter's claim of origin. Similar to what I said about binding tariff informations before, you can have origin rulings. So you can have an advanced origin ruling if you import or export from Great Britain, and you can have a binding origin information decision if you import into or from Northern Ireland. And these are similar to the BTIs and the advanced tariff ruling. They're legally binding rulings that confirm the origin of specific goods, and they're valid for 3 years. That's the same period as the BTIs and so on. Now, where you're importing goods under preference, you must keep those documents for 4 years. And again, similar to what I said earlier, if there's a criminal investigation, then the 10-year rule applies. So the longer you can maintain your records, the better, really, to be honest with you. I'm not suggesting that any of you are subject to any criminal activity. for 1 second. And moving on to customs special procedures and facilitation. So while we were a member of the EU, the UK was part of what's called the Union Customs Code. And that's kind of like a framework, a legal framework for customs rules and procedures in the EU territory. Now, we have replicated much of that framework, meaning that the facilitations and simplifications that were available to us before 2021 are still available. And they're really, the purpose of them is really to reduce customs admin and cost burden on traders, but also to speed up the flow of goods. So I've put a few of them down here, that there's tons of information on HMRC's website about them. But what I really wanted to raise was, when you obtain authorization from HMRC to use one or a combination of these procedures, it's like being granted a certain level of trust that you can maintain correct data and ensure compliance. So your accurate record keeping is paramount. So, and I hope that kind of is coming through throughout this presentation. Your record keeping needs to be prioritized within the business. Now, how these procedures are reflected on the CATH, or the Export or Import Declaration, is via customs procedure codes, or you might refer to them as CPCs. These are really important 7-digit codes that effectively tell customs why the goods are being moved. And they serve to show the customs procedure that your goods are being moved from and then into. Now, there are some, I think, 350 plus code combinations for import alone. So, reach out and seek advice if unsure. As the importer and exporter of record, it's your legal responsibility to ensure agents have accurate information as to the purpose of the movement of goods, and importantly, have any relevant HMRC authorizations to be referenced on the declaration. And then it's also the trader's responsibility to ensure that the goods entered into a procedure whereby duty and VAT is suspended. So I'm thinking here, something like inward processing, that those goods are discharged correctly and within the permitted time frame. So goods that have been declared into inward processing upon import into the UK, you have to ensure that HMRC is notified when those goods have been either re-exported or released into free circulation or written off, for example. Now, different procedures will have different record keeping requirements. So again, record keeping is really, really important. For inward processing, for example, I think it's 4 years. You have to keep records for 4 years after their export or disposal. But when you're granted authorization from HMRC, they'll notify you of all of the compliance requirements at that stage. Okay, so moving on. I get sick of the sound of my own voice in these webinars. Market regulatory requirements, not really a huge amount to say here, just other than there are a raft of regulations and directives that apply to products across different sectors and across different markets. And this obviously impacts on a trader's ability to place goods on the destination market, be that the UK or overseas. Now, the regulatory landscape is a little bit more complex for GB traders now, Great British traders, whereby we sell product in the UK, Northern Ireland and the EU. Because obviously, since Brexit, the UK and EU are operating separate regulatory frameworks and legislation. So as I said earlier, Northern Ireland's kind of suspended in a kind of hybrid situation in the customs territory of the UK, but remaining in the EU single market for the purpose of goods. So this has had huge complications for traders across many GB sectors for things like REACH related to chemicals, CE and UK CA marking, responsible persons food labelling, and a whole host of other things. For importers, those of you importing, the UK trade tariff is a pretty good source of information on UK import controls and applicable regulation. And for those of you exporting, Gov.UK's export goods from the UK provides a kind of basic framework, but you can build on that and drill down into specific export market regulations. So it's a good place to start. Denied party screening. This is an important one. When we do audits on some of our clients, we go in and do trade compliance reviews. They're kind of like mini HMRC audits. Very few are doing denied party screening. So this refers to the process of comparing names of customers, business partners, even facility visitors against official watch lists of individuals and entities who technically it's illegal for us to do business with. So this screening is a crucial element of most export compliance processes because it helps safeguard traders against violations. Now, denied party screening and restricted party screening are used interchangeably, but strictly speaking, there is a difference between the two. So a denied party has effectively had its exporting privileges revoked or denied. So it might still be able to do business. You might still be able to do business with a denied party and sell them goods. But if that denied party then exports or re-exports those goods, it would constitute an export compliance violation. And then that renders you as the UK trader complicit in the violation. Now, you can get around this to a certain extent by insisting on end use and end user statements. They can be quite effective, an effective way of safeguarding against these kind of eventualities. But then a restricted party has had its trade or business restricted. And these restrictions can be partial, in other words, specifically preventing transactions and trade of certain goods or technologies, or they can be total, meaning that no business is allowed to be conducted with them. So as you can see, denied party and restricted party are really quite different. Now, denied party lists, these are lists of individuals, organizations, entities with whom we can't do business, either in, wholly or in part. These are maintained by government and international bodies around the world. And as best practice, and I can say firmly it doesn't happen as often as it should, traders should screen all entities they deal with against a denied restrictions party list. So this would include suppliers, new employees, mergers and acquisitions, freight forwarders, the whole list. The UK sanctions list is absolutely the go-to place in the UK. It lists people, entities and ships that are designated or specified under regulations made under the Sanctions and Anti-Money Laundering Act of 2018. And then why they've been specified under those regulations. And then I've also given some other sources of information and advice on this slide. The other thing I wanted to talk about was prohibited and restricted goods. So the export of strategic goods and technology is the remit of the Export Control Joint Unit, or the ECJU. But that's overseen by the Department of Business and Trade, which I mentioned in the introduction. So certain goods fall under their remit and controls are imposed on the trade of those goods for a number of reasons. It could be that a government has concerns about repression or regional instability or human rights violations within that target market. There could be concerns about the development of weapons of mass destruction, or the target market could be the subject of a UK or United Nations trade sanctions or arm embargo. Again, the UK trade tariff is a terrific resource and will list all the restrictions on your goods against the Commodity Code. But I've given some examples here on the categories of goods that are most likely to be controlled. Licensing is a complex and really specialist area, and I really strongly recommend you consult the ECJU if you think you have an export licensing requirement. But as the exporter, it is absolutely your responsibility that you get licensing in place if the goods require it. And then proof of export, as I mentioned in the very beginning, this is an area where as exporters, we tend to fall down a little bit. So maintaining proof of export is a major part of HMRC's compliance, and many exporters are unaware of their obligations in this area or of the consequences of not complying. So essentially, as UK exporters, we zero rate the VAT on our exports, but then we need to be able to produce official or commercial evidence supported by a whole host of supplementary evidence to show that that transaction took place, and importantly that the goods were physically exported within 90 days of the export declaration being made. That time period is really important. In the case of an HMRC audit, if proof of export couldn't be produced or it was deemed to be by HMRC insufficient, then that VAT zero rating would not apply. And it would be the exporter that would be liable to account for the VAT that's due. So that can be a pretty stiff penalty. Outside of that, there are various different forms of evidence that would be deemed acceptable in the event of an HMRC audit. And the evidence varies depending on whether the exporter is responsible for shipping the goods. So maybe they're shipping DAP or DDP, or whether the customer is collecting via ex-works or FCA. When the exporter is responsible for shipping the goods, obtaining that proof of export is a lot simpler than when the customer is collecting. Now, there's a really good VAT notice 703, section 6 goes through all of the different kind of commercial and official documentation that HMRC will accept. Fast parcel operators, so like the likes of DPD, UPS, Parcel Force and so on, they're a lot easier to deal with because they have their portals that track shipments. So you can physically see when goods have been delivered. So it's a lot easier to get that proof of export. Some of our clients ship via the post office, and post office offers a form P326 that serves as a proof of export. And importantly, your proof of export needs to be maintained for 6 years. So that's probably the more lengthy of the expectations in terms of documentation that HMRC have. So that's really, really important. Okay, customs valuation, we're motoring through this. So valuation, just as the word suggests, it's just the process of assigning a customs value to your goods so that HMRC can apply the right level of duty and VAT. So import duty rates from third countries can be found against the commodity code and the tariff, which is an important part of getting your products classified correctly. Now, there are 6 different valuation methods available. I've listed some of them here, but 90% of businesses use method 1. And effectively, that requires you as the trader or the importer to add the cost of freight and insurance to the value of the imported goods to get what we call the cost insurance freight price, the CIF price. And then it's on that price that duty is calculated, and then on that whole price that VAT's calculated. So VAT is calculated on the CIF cost plus duty. Now, again, correct classification of goods is essential, and it's your responsibility as the importer to get that right. Now, any documentation relating to customs valuation you have to maintain for 4 years. Okay, so it's 4 years for customs valuation documentation. Payment of duties and tax. So once import duties are calculated, you've got several different payment options at your disposal to settle with HMRC. So I've listed them here. Duty deferment accounts have grown in popularity since the government introduced the 10K waiver in 2021. So it now means that solvent and HMRC compliant companies can obtain a duty deferment account without the need for a customs comprehensive guarantee from their bank, so long as their debt doesn't exceed that 10K per month. So obviously duty deferment accounts are popular with customs because they allow for the faster clearance of imported goods. And also in terms of a kind of cash flow benefit to importers, in some cases you can recognise up to a 30-day period before you have to pay that duty to HMRC. And that's obviously different to using an agent's account, whereby the accounts used, their accounts used simply to clear the goods at customs, and the outstanding payments either added to your credit account if you've got a line of credit with them, or collected from you before you receive your goods, and they'll typically charge you a facilities fee for using that deferment account. You have to instruct the agent as to how you want the duties to be deferred so that they can use the correct codes on the import declaration to show how the duty's been paid, and also the correct account numbers for the deferment accounts can be put into the C88. Really importantly, when you're thinking about a duty deferment account, you'll remember I mentioned about customs special procedures earlier. You have to consider any customs special procedures or temporary storage facilitations when you're thinking about a duty deferment account. So anything like customs warehousing or inward processing, because under those procedures, you're technically suspending duty and VAT, and that's classed as potential debt. So a duty deferment account and a customs guarantee, if required, must be sufficient to cover both the actual debt, i.e. the duty that's been deferred when the goods were cleared, but also the potential debt for any products that are suspended under a customs special procedure. And it's your responsibility to manage the duty deferment account effectively and make sure that its debt are within permitted limits throughout the month. Postponed VAT accounting for import VAT, also widely used now, and that was introduced post-Brexit, because this allows the VAT element of import duties to be offset against your VAT account instead of being paid as the goods are cleared, or if you've got a duty deferment account, offset against that account. Now, there's no authorisation required for postponed VAT accounting, but you must have access to CDS, so the Customs Declaration Service, which is HMRC's new underlying customs platform, because this is where VAT statements are stored. So your VAT statements are typically available to view by the 8th working day of the month, but they can only be accessed for 6 months from publish date, and after that point they're archived. So you must ensure that you download these, and importantly from a compliance perspective, that import VAT is accounted for correctly within the organisation. Okay, so moving on to maintaining documentation, a robust system, as I said earlier, for keeping business records is absolutely paramount, because this helps you remain compliant with HMRC and other customs authorities' regulations, and it allows HMRC to carry out audits effectively. So in their guidance, HMRC will say that records must be accurate and up to date, they must be legible, they must be readily accessible, whether hard or soft copy. They don't care whether it's hard or soft copy, but they must be linked and available for inspection at all reasonable times. So essentially you want to have import and export dossiers for specific consignments, whereby you have maybe the C88 at the core, and from that you can easily retrieve the purchase order, the commercial invoice, any transport documentation, and so on. Now, the archiving period for records varies according to individual procedures. So I've mentioned some already this afternoon, but I just wanted to mention a couple of others. So anybody that's involved in excise goods, your record should be kept for 6 years. Anybody obtaining health certificates that are signed and stamped by an official vet, they should be kept for 2 years. Any intra-trade animal health certificates, they're kept for 3 years. Phytosanitary certificates, so they're for plants and wood and so on, they have to be kept for 2 years. So sanitary and phytosanitary certificates, 2 years. Where a certificate of conformity is required, so perhaps you're importing fresh fruit, vegetables, salad crops, whatever, the requirement is 3 years. And if you're using a free zone or a customs warehouse, those stock records that you keep must be kept for 4 years after the goods have been removed from that customs warehouse or free zone. So it's really important that you understand the documentation that you need to maintain and the time periods by which you need to maintain it. And then I just wanted to touch on transport documents as well, because they should be kept. And typically, I think that falls in with the C88 4-year requirement that I mentioned earlier, really. So when I'm talking about transport documents, I'm talking about shipping orders, bills of lading, seaway bills, so on, because these can be really useful kind of supplementary documentation that you can produce during an audit. So in my view, I'm kind of really belts and braces when I'm talking to clients. The more that you can maintain, the better, and the more detailed and the more easily retrievable that it is, the better, really. Generally speaking, the rule is that you have to keep a lot of documentation for 4 years, but given that HMRC can go back 6 years if it deems that you've been careless, you know, if you're regularly making or having to correct mistakes, then it can go back 6 years. So I always say to clients, 6 years is kind of like the golden number. Now, penalties, I hate talking about this bit, but it kind of reinforces the importance of being compliant. So it's taken, the whole compliance matter is taken really seriously in the UK and in other markets, and the impacts of getting it wrong can be far-reaching. So kind of fraudulent declarations and dishonest claims for a payment of duty or relief from duty are likely to be met with what we call civil evasion penalties. And actually repeated examples of poor record keeping are also met with these penalties. So there are a number of penalties that are imposed under the Finance Act 2003. And the size of the penalty is often influenced by the level of cooperation given to the investigating officer. The more cooperative you are, the less likely, well, it does have a direct impact on the size of the penalty that you might get. I've listed notice 300 and notice 301, as that gives more details in this area. And I don't want to dwell on it too much. It's just, you know, the more you can internally audit your documentation and your records, and then if you find discrepancies, proactively approach HMRC, the better, really. And the more you can have procedures in place to check work before perhaps customs entries or agents' instructions are given, then you're reducing the likelihood of any kind of discrepancies as well. And the only other final point to make on this is, in exceptional cases, HMRC can pursue sanctions through criminal courts as well. So it's really serious stuff. I think they recognise when it's a genuine mistake, and I think, you know, there would be a certain level of leniency awarded for, certainly for the first 12 to 18 months post-Brexit, when nobody had a clue what was happening. But I think now we're starting to have sufficient information to get our act together and make sure that we're maintaining documentation correctly and for the required period of time. Okay, so I just want to touch upon, in case there's any of you on this call from the East Midlands area, because there is this programme that we've been running for the 3 growth hubs, so Business Lincolnshire and Business Gateway, and also D2N2, where we've got a whole host of support, one-to-one, one-to-many support, and we've got peer support and so on. I suppose the one that I would draw your attention to would be the trade compliance review, which is what I referred to as like a mini HMRC audit earlier. So anybody that's within that territory, that's fully funded by the growth hubs. But also I have listed the webinars, the upcoming webinars. You can see we've got kind of 7 core webinars, of which today is the first, and then we've got 5 sector specific. They were based on the kind of leading sectors across the East Midlands as they're funding these webinars. There's very little by means of eligibility criteria for this funded support. So you have to be an SME based in one of the 3 regions. The only one that we impose any kind of revenue requirements on is for our global trade manager or export manager program, because they're kind of 30 hours of fully funded support. So the growth hubs want to know that the client in receipt of that is in a position to properly invest in import or export and really take the learning to that next level. So again, there are various different routes for you to access that support, that fully funded support. There's a dedicated email address, so you can just give us a call. There's also a dedicated programme page on our website at globaltradedebt.com, but we've also got an Eventbrite page for all of the one-to-ones and peer groups and webinars on there. But if you're joining us from outside of those regions, that's absolutely fine. We've really enjoyed being able to present to you today. Please do attend the future webinars, the ones I've just talked about. They are advertised on LinkedIn and they're also on Eventbrite. And also for all clients, irrespective of which region they're coming from, we do offer a free 30-minute one-to-one discussion. There are very few import or export challenges or objectives that we haven't been able to help clients with, so we're always keen to hear from your businesses. So you can book that one-to-one session directly via our website. We have a Global Trade Clinic tab, or you can just drop us a line at contact@globaltradedebt.com, or again you can give us a call. Okay, and certainly I'll get my team to circulate these slides to those of you that have attended today, so you've got all of this detail. And then finally, they're my personal details there. So please do feel free to connect with me on LinkedIn if we're not already connected. And that's really it. I'm just going to go and have a look at the Q&A and see what we've got. Eventbrite, please can I have a copy of the webinars? I missed a large part at the start. That's absolutely fine, Dale. That's not a problem at all. Shruti, we can get those to you today, I think. And Paul, you're asking the same problem. Dale, here's a good question. So has the introduction of the 10K duty deferment account reduced the demand for UK businesses to invest in gaining AEO status? I've heard a UK Academy trader tell customs courses attended AEO is only for large companies. Interesting. My view on AEO applications is we have seen a slight decline, but I don't think it's linked to the 10K duty deferment account introduction. I actually think it's more down to the fact that there was a level of urgency placed on must have AEO status in the build up to Brexit, because we were told that, you know, if we were AEO accredited, then we were going to have our goods fast track through customs. And, you know, the reality is that's not going to happen. If your goods are going via a groupage load, customs aren't going to pull out your small consignment, you know, and hold up something else and fast track yours. So I think it's more a case of, sadly, that the kind of impetus has gone. I think it's something worth pursuing if you have the time to invest in it. If you're already kind of ISO compliant, the likelihood is you've got a lot of your processes mapped and processes documented, and a lot of that goes into AEO. So you might find that you're best part of the way there. And why I think it's worthwhile is it's becoming a bit of a kite mark and does make you stand out as a manufacturer or an agent or a warehouse operator. For example, we do work for clients where we often find them storage overseas, and I probably wouldn't look at a warehouse that wasn't AEO certified, or, you know, it kind of sets the bar. It sets expectations, if you like, that you perform a level of self-governance, be that on customs or safety and security, so on. So I don't think it's linked to the duty deferment account. I think it's a no-brainer to get a duty deferment account with that 10K waiver. Very few of our clients exceed that 10K in a month. We focus on the SME market, so 10K is a reasonable amount to set as a limit. So yeah, I hope that's kind of answered your question, Dale. And Brian, how do you see the forthcoming changes to the border as outlined in the operating model released last week? Packaging the flow goods. How can a UK trader of products covered food plant prepare for the changes? Oh, so I just tuned into an Institute of Export webinar yesterday about this whole thing. And I'm still getting my head around it. I think it's a good thing. I think it's kind of, you know, simplifying things and may speed up the flow of goods and may also make us slightly less, you know, burdensome to trade with and so on. I think I need to get my head around, because I think what you're referring to there, Brian, is the one that's actually still out. So the new operating model that's still technically out for consultation. There's a lot of teaching sessions available for different categories of goods that are being offered by DEFRA. If anybody's affected, I would urge you to sign up to those, because that is going to give an overview of how certain processes are going to be simplified and streamlined. I think any kind of efforts to reverse some of the complexity that Brexit has introduced can only be a good thing. The targets that the government has set for implementing this, I'm a little bit skeptical about, bearing in mind, you know, we're 2023 now and we still haven't implemented some of the things that we were meant to post-Brexit. But I'm still getting my head around it. So perhaps that's something we can talk about in the next webinar, where I might have had a chance to read through the document fully. But I hope that helps, Brian. And thank you. Sorry, to see your message about the link via LinkedIn. Thanks. And okay. Perfect. Good summary presentation. I hope you've done some more specialised webinars in the future. That's wonderful, Paul. We look forward to welcoming you to those. I just want to say, everybody, thank you so much for your time today. I'm sorry I have no camera. That will be rectified next week. If you're tuning in next week for our manufacturing webinar, you will see me, although really you're not missing much today. Like I say, reach out, we'll circulate these slides, reach out if you've got any questions at all. If I don't know the answer to them, then I have a whole bunch of associates and colleagues who I can refer them to, so don't be shy. Okay, everyone, thank you so much. I will let you go and hopefully see you over the coming weeks. Take care, bye-bye.